Have you ever wondered why some Forex trades feel smooth while some others feel totally chaotic? Why one pair moves calmly and the other one explodes without any warning? Here's the truth most beginner traders learn the hard way. Not all currencies move the same way. Some are stable, some are fast, and some can even wipe out your account if you don't know how to handle them. Today I'll break down major, minor, and exotic Forex pairs, what they really are, how they move, and which ones you should start with at first if you're trying to succeed and to survive in the Forex market. Let's rewind for a second. If you've ever traveled abroad, you already used the Forex market. Forex, short for foreign exchange, is the market where currencies are bought and sold. But instead of planning vacations, traders benefit from the actual price movement of the currencies. And this market, ladies and gentlemen, is massive. I'm talking about $7 trillion of daily market volume. And at the center of all of these are the currency pairs. Pairs, exactly because you can never trade one currency alone. You always trade them against one another. Let's start with the simple example of EURUSD. Euro is the base currency. US dollar is the quote currency. If EURUSD is at 1.10, that basically means that 1 euro is worth 1.10 US dollars. When you enter a buy position at EURUSD, you're actually betting that the euro will strengthen. If you were to enter a sell position, you think that US dollar will strengthen against the euro. I mean, it's simple in theory, but the things change when you consider that each pair has a different personality. Another very important thing is liquidity. Think about selling a phone. In a big city, you might sell it very fast, in a matter of a day or two. But if you're in a small town, it might take days, weeks, or even months. That is liquidity. Translated to Forex, high liquidity would mean smooth trades and low costs. Low liquidity, on the other hand, means delays, wider spreads, and sudden price jumps. And this is exactly why the Forex pairs are categorized into major, minor, and exotic pairs. The currency pair is considered a major pair if it contains the US dollar, the most traded currency in the world. The most popular examples include EURUSD, GBP/USD, USD/JPY, USD/CHF, or AUD/USD. These pairs actually make up to 80% of the trading market. Why do traders love them? Because they're highly liquid, cheaper to trade, easier to analyze, and more predictable. Next up, minor pairs, also known as cross pairs. These don't include the US dollar. Examples include EUR/GBP, AUD/JPY, or EUR/CHF. I mean, they are not bad, they're just a little bit different. Because these minor pairs have slightly wider spreads, they move fast during specific sessions, and they react strongly to regional news. If you enjoy understanding country-specific stories, like Europe versus Japan, or Australia versus Asia, then minors can be very rewarding. Now let's talk about the high-risk territory, exotic pairs. These combine a major currency with one from a smaller, developing country. Examples include USD/TRY, USD/ZAR, EURUSD. Exotic pairs are less liquid, more volatile, and highly sensitive, especially to political and economic shocks. They can move fast, but not always fairly. Think of them like spicy food. Exciting? Yes. Beginner-friendly? No. Here's the difference in very plain terms. Major pairs are calm and structured. Minor pairs are analytical and regional. Exotic pairs are emotional and unpredictable. And the best pair isn't the most exciting one, it's the one that fits you best. So before choosing a pair, you should actually ask yourself, how volatile am I comfortable with? When do I usually trade? And do I understand the economy behind this currency? If you trade during European or US hours, then major pairs make sense. If you trade during Asia session, AUD or JPY pairs move better. Remember that volatility creates opportunity, but it can also create damage. While majors move steadily, exotics can move without a single warning. And smart traders don't necessarily choose volatility. They measure it, respect it, and manage risk around it. But no matter what pair you trade, always use a stop loss. Never risk more than 1 or 2% per trade, and don't overload on correlated pairs. Remember that your goal isn't to avoid losses, it's to survive long enough so you can make wins. Some traders love calm charts, others crave movement, and neither is wrong. But trading pairs that don't match your temperament leads to frustration, overtrading, and burnout. When your pair matches your personality, trading feels natural and not stressful. To wrap it up, major pairs teach patience, minor pairs teach adaptability, and exotic pairs teach respect. Forex isn't about beating the market, it's about understanding it. Start simple, trade smart, and grow step by step. Until next time.
Hola Prime, trade with transparency.